Silver price just spiked. One word. Defined. What happened? Today, billions of dollars moved, not because of a war, not because of a crash, not because of any breaking headline, but because of one single word. A word so quiet, most traders didn't even notice it, but the institutions noticed, the bond markets noticed, and within hours, silver tore through levels it hadn't touched in weeks. And this wasn't random. This wasn't luck. This was a signal. And by the end of this video, you will know the exact word that triggered it, the same word that could decide where silver goes next. So stay with us, because what happens after this word is far more important than the word itself. The channel where we don't just watch the markets, we understand them. Before we go further, may I ask something of you? If you've been with this channel for some time now, and you found even a little bit of value in what we share, would you do us the honor of pressing that subscribe button? It costs you nothing, but it means everything to us. It's how this channel continues to grow, and how we continue bringing this kind of analysis to you free of charge. And one more thing, we'd genuinely love to know, where in the world are you watching this from today? Drop your city, your country, right in the comments below. It helps us understand just how far this community has reached. Now, let's get into it. For 7 weeks in a row, silver had been losing ground. Every Friday seemed to bring the same pattern. Prices would rise during the week, only to fall sharply as the weekend approached. Traders had started to expect it. Some even called it the Friday Smackdown, a phrase that captured just how predictable the pattern had become. But this Friday was different. Instead of falling, silver surged. It climbed past 2% early in the day, then it kept climbing. By the time the trading session reached its peak, silver had jumped nearly 4% from its recent low. In dollar terms, that meant a rise of more than $4 in a single day. For a metal that trades in a narrow range most of the time, this was not a small move. This was a shock. To understand how unusual this was, it helps to look at where silver had been just hours earlier. Earlier in the week, silver had dropped below $56 an ounce. That was a sharp fall from levels traders had grown used to. Many believed the metal was entering a longer period of weakness. The mood among traders was cautious, even a little discouraged. Then, almost without warning, everything reversed. Silver raced higher, eventually touching $59.69. That put it just 31 cents away from the psychological barrier of $60, a level many analysts see as the gateway to a new trading range. Gold moved higher as well, gaining about 1%. Platinum and palladium followed the same path, both rising in tandem. Even the gold to silver ratio, a number used to measure how silver performs relative to gold, narrowed. This signaled that silver was outperforming gold on this particular day, a detail that experienced traders pay close attention to. On the surface, this might look like just another day of market noise. Prices go up, prices go down. That is the nature of markets. But for those who study these movements closely, this kind of sudden reversal raises an important question. What changed? Because the truth is, nothing dramatic happened in the world that day. There was no major war, no surprise announcement, no emergency meeting, no single piece of breaking news that could explain a move this large. And that is exactly what makes this moment worth examining. When markets move this sharply without an obvious cause, it usually means something deeper is happening beneath the surface. Prices do not simply jump on their own. Something shifts in the way traders think, in the way institutions position their money, and in the way confidence is measured across the financial system. This is where the story becomes interesting. Behind every sudden market move, there is almost always a story of expectations changing. Markets do not just react to facts. They react to belief. They react to what people think will happen next. And sometimes the smallest shift in belief can cause the biggest moves in price. That is precisely what happened here. While most people were focused on the surface level numbers, something quieter was unfolding in the background. It involved interest rates, central bank decisions, and a growing sense of uncertainty about what comes next for the economy. None of this was loud. None of this made front-page headlines, but it was powerful enough to move billions of dollars in a matter of hours. The single shift can be summed up in one word, a simple word. A word that does not sound dramatic at all when you first hear it. But once its meaning is understood, it becomes clear why it had such a strong effect on silver, gold, and the wider financial markets. That word will be explained in detail next. But first, it is important to understand the bigger picture. This was not just a one-day event. It was part of a longer pattern that has been building for weeks, even months. Bond markets had already been sending signals. The US dollar had been weakening. Yields on government debt had been falling. All of these pieces were connected, even if most people were not watching closely enough to notice. For the business community, the entrepreneurs, and the decision makers who pay attention to where money is moving, this is not just a story about silver. It is a story about confidence, expectations, and how quickly sentiment in financial markets can shift. And it all comes back to one word, a word that explains far more than most people realize. That word is doubt. It does not sound powerful. It is not a word that makes headlines. No news channel would ever run a breaking story with the title, "Doubt Strikes Markets." Yet this single word, quiet as it is, carried enough weight to move billions of dollars in a single trading session. To understand why, one must look at where this doubt came from. For months, the financial world had been watching the Federal Reserve closely. The Federal Reserve is the central bank of the United States, and its decisions about interest rates affect almost every corner of the global economy. When the Fed raises interest rates, it usually makes holding gold and silver less attractive because investors can earn more simply by keeping their money in interest-paying accounts. When the Fed lowers rates, or even hints that it might lower them, gold and silver tend to become more appealing again. For a long time, traders believed the Fed would continue raising rates, or at least keep them high, especially with inflation still running above target. This belief had been pressuring silver and gold for weeks. It was part of the reason silver had been falling every Friday, part of the reason it had dropped below $56 earlier in the week. But belief is fragile, and on this particular day, that belief cracked. Traders began to doubt whether the Federal Reserve, now under new leadership, would actually follow through on raising rates anytime soon. This doubt did not come from one single announcement. It grew slowly from a combination of small signals. Bond yields had already started falling in the days before. The US dollar had weakened, and data on the economy painted a picture that was less certain than before. This is an important lesson for anyone trying to understand markets. Big moves are rarely caused by one big event. They are usually caused by a slow buildup of small doubts that eventually reach a tipping point. Once that tipping point is reached, the market reacts all at once, even though the underlying shift had been happening gradually. When traders began to doubt the Fed's next move, government bonds reacted first. Bond prices rose, which pushed yields down to their lowest level in 7 weeks. At the same time, the US dollar fell to its weakest point in over a month. Both of these movements matter greatly for gold and silver. Here is why. When bond yields fall, holding cash or bonds becomes less rewarding. This makes gold and silver, which do not pay any interest, relatively more attractive. And when the dollar weakens, gold and silver become cheaper for buyers using other currencies, which increases global demand. So, when doubt grew about the Fed raising rates, it triggered two forces at once, falling yields and a weaker dollar, both of which pushed precious metals higher. This is the deeper mechanism behind the spike. It was not random excitement. It was not a sudden rush of buyers with no reason. It was a logical chain reaction, triggered by a shift in expectations about future interest rates. What makes this story even more interesting is the timing. This doubt emerged just as new economic data was being released. Inflation numbers came in higher than the Fed's long-term target, yet traders still leaned toward believing rate hikes were unlikely in the near future. This is somewhat unusual. Normally, higher inflation would increase the chances of rate hikes, not decrease them. This tells us something important about where confidence in the market currently stands. Traders are no longer reacting purely to inflation data. They are also weighing political pressure, leadership changes at the Federal Reserve, and broader uncertainty about the direction of the economy. In simple terms, the market is no longer fully confident that the central bank can move as freely or as predictably as it once could. For the business community and entrepreneurs watching from the outside, this matters far beyond silver and gold prices. It is a signal about how fragile market confidence has become. When a single word like doubt can move an entire asset class within hours, it shows just how sensitive the financial system currently is to changes in expectation. And this is only part of the picture, because behind this one word lies a much larger set of numbers that reveal just how deep this uncertainty runs and how long it has been building beneath the surface. Doubt does not appear out of nowhere. It is built from data. And to understand how deep this doubt really runs, it helps to look closely at the numbers that have been quietly shaping it for weeks. Start with inflation. The Federal Reserve watches a specific measure called core PCE inflation, which excludes volatile items like food and fuel. In the most recent reading, this measure rose close to 3.4%. That is well above the Fed's long-term target of 2%. On the surface, this should make rate hikes more likely, not less. High inflation usually pushes central banks to act, not pause. Yet something else stood out. Core PCE inflation has not fallen below the Fed's 2% target for over 5 years. That is the longest stretch of elevated inflation seen in nearly 3 decades. For traders, this raises an uncomfortable question. If more than 5 years of effort has not brought inflation back to target, how much real control does the central bank actually have left? This is where a second, quieter measure becomes important. Economists also track something called trimmed mean inflation, which removes extreme outliers to show the underlying trend more clearly. That number told a slightly different story. It had only risen to a 4-month high of 2.4%, and it had been falling on a yearly basis for 3 years straight. This created a strange contradiction. Headline inflation looked hot. The underlying trend looked cooler. And whenever data sends mixed signals like this, doubt naturally grows among traders trying to decide what the central bank will do next. Bond markets offered another clue. In the days leading up to this spike, yields on 10-year U.S. government debt fell to their lowest level in 7 weeks, dropping beneath 4.35%. Falling yields usually mean one thing. Investors are positioning for a future where interest rates stay lower, or at least do not rise much further. This is a quiet vote of doubt, expressed not through words, but through where large amounts of money are being placed. At the same time, the U.S. dollar weakened to its lowest point in over a month. A falling dollar often goes hand in hand with falling confidence in future rate hikes. When investors believe rates will stay lower for longer, the dollar tends to lose some of its appeal compared to other currencies. This was not a small move either. It marked one of the more noticeable declines the dollar had seen in recent weeks. There was also a piece of trade data that quietly added to the uncertainty. The latest figures showed one of the deepest monthly trade deficits in goods seen in years. While this number did not grab major headlines, it added another layer of concern about the broader strength of the U.S. economy, feeding further into the climate of doubt. Consumer sentiment data added one more piece to this puzzle. A widely followed measure of how confident everyday Americans feel about the economy showed a small improvement, but it remained at historically low levels, far below where it stood just a few years earlier. This told analysts that even though sentiment had ticked up slightly, the broader mood among the public was still cautious, not confident. When all of these numbers are placed side by side, inflation that refuses to fall fully, bond yields dropping to multi-week lows, a weakening dollar, a widening trade gap, and consumer confidence still sitting at low levels, a clear picture begins to form. This was not a market reacting to one single piece of news. This was a market absorbing weeks of conflicting signals, all at once on a single trading day. This explains why the move in silver was so sharp. It was not built from nothing. It was the release of pressure that had been building quietly across multiple parts of the economy, finally surfacing in one dramatic price spike. But numbers alone do not tell the full story. What matters most now is what these numbers mean for the future, and what serious decision makers should be watching next. Numbers explain what happened, but the real value for serious decision makers lies in what comes next. History offers a useful guide here. Whenever doubt grows about a central bank's ability to control inflation, gold and silver tend to benefit. This is not a new pattern. It has repeated itself many times over the decades. When people lose confidence that a currency will hold its value, they look for something that has held value for thousands of years. That is the basic reason gold and silver exist as financial assets in the first place. They are not just metals, they are a measure of trust, or in this case, a measure of doubt. What makes the current moment worth watching closely is the scale of the institutional response already underway. Analysts at a major Swiss bank have forecast gold reaching $5,200 within the next 12 months. This is not a casual guess from a small trading desk. It is a forecast built on the belief that inflation will only partly ease, while confidence in central bank policy continues to weaken. When large institutions begin making forecasts like this, it usually means they are also positioning their own capital to match that view. For silver specifically, the number to watch closely is $60. This level has acted as a psychological barrier, a point where the metal struggled to push through during its recent climb. If silver manages to close firmly above this level in the coming weeks, many analysts believe it could open the door to a new, higher trading range. If it fails to hold, a pullback toward the $55 to $50 zone remains possible, a level some still view as a strong floor rather than a sign of weakness. This is the nature of markets recovering from doubt. They rarely move in a straight line. They test levels, retreat, and test again until confidence either returns or fades completely. For the business community and entrepreneurs following this story, the lesson here goes beyond silver and gold prices. It is about understanding how quickly confidence can shift in a financial system that many assume is stable and predictable. A single word, doubt, was enough to move billions of dollars in a matter of hours. That is not a small detail. That is a warning sign about how fragile expectations have become across the entire economy. This does not mean panic is the right response. Markets have weathered uncertainty before and will continue to do so. But it does mean that paying close attention to interest rate decisions, inflation data, and central bank communication is no longer optional for those serious about protecting and growing their capital. These are no longer background details. They have become frontline indicators of where major asset classes are likely to move next. The coming weeks will likely bring more clarity. Inflation data will continue to be released. The Federal Reserve will continue to communicate its plans or its hesitations, and markets will continue to react, sometimes loudly, sometimes quietly, to every shift in confidence. What this moment has shown clearly is that doubt itself has become a measurable force in today's economy, one capable of moving markets just as powerfully as any official policy decision. And for those paying close attention, that may be the most important lesson of all.